introduce you because
Okay.
I have to do that. So Maj Soueidan is a co-founder of GeoInvesting from 2007, I think.
Yep.
But he's a microcap investor for the last 35 years. So I think Maj could be one of the most experienced US microcap investors who, for me, it's a pleasure to have Maj here. I think I know you 2 years ago, maybe when we talked about Altigen. I think I try to remember that. So, and well, it's a pleasure for me and for this YouTube channel. The people that connects to this YouTube channel, Maj, it's investor, retail people, it's some professional investors, and some people that they want to learn more about how to invest, about equity valuation, about financials, this kind of thing. So they want a plus against all the YouTube channels that you can find. No? And I think here in Spain, this channel is the most in-depth channel related to equity valuation and microcaps and this kind of things. No, we bring people like CEOs, investors, analysts to the channel. We have a new section, who is this one, his interviews with one of the best investors, CEOs. So I think you are one of them. And if you are okay, I distribute this interview in 4 blocks. And the first one is to talk about your life before GeoInvesting. So when you start to interest for stocks, I know that your father was an investor, and I think and your father give you a Peter Lynch book, and I think all starts with Peter Lynch. No, so you can talk about that. And then I like to focus in GeoInvesting from 2007 and how you works about the financial crisis, because it's not easy to set up a business and then have a drawdown of 60% in the equity markets. I think this is a difficult time.
Right.
And then I know that you are going to focus on China, and you have a good documental that talk about investing. And then at the end, and the most important for me is I like that you can explain your investment philosophy in deep detail about your qualitative analysis and also your quantitative analysis. Okay. And this is most of how I think this interview. People can make some message like this. You can see in the screen. Okay. Then I can read for you. But if you see some message, some comment in your screen, not worry. So that's normal. Okay.
Hi, Alvaro. Nice to meet you. Got the right pronunciation.
Yeah. I like this because this is an opportunity for the people to talk with CEOs, to ask questions, or to ask questions to you. I think it's interesting. Okay. If you want to start with your child time, when you have, I don't know, 14, 16, when do you start to be interested in stocks?
Sure, and by the way, thanks for doing this, and thanks for that great intro. It's probably a little overestimate of my qualifications, but no, thank you very much. And this is really a pleasure. I always love talking to you and other investors, just talking shop. It's really fun to me, and that's what investing has always been for me. It's been fun. It was one of those things where I didn't know what I wanted to do. I came out of high school. I had an economic class, and maybe it's good starting there because that's where I got my first kind of lesson in investing. And so I think I was maybe 11th grade or so. And and I hadn't read and like any really investing books yet, but by that time I was watching my dad do investing here and there, and he'd watch business shows, and I'd sit there and watch them with him, not really knowing what's going on too much. But I was kind of fascinated at how you could make money in these in companies by just investing in them. But I really never got into it. And then this economics class, my teacher's name is his name was Mr. Knight. I forgot his first name, elderly gentleman. And so I don't know why that day I happened to have a Wall Street Journal in my hand, whatever. And I don't know, maybe I was showing off and being stupid, but he's like, all right, well, I can see you got this paper in your hand. Well, this is a good time to talk about class. We're going to do an investment contest, and fake money, and we're gonna have a little fun with that. And I think it was like $100,000 fake money, and that was it. So I remember I didn't know where to start, and I think that's where a lot of investors are. You also want investing. Where do you start? And I came across, I don't know how I came across it initially, but I was just reading the Wall Street Journal. And I think I was reading about some disk storage companies, and I came across this company called Storage Technology. And
is it existing right now, or is it dead?
They're done. I think they might have got acquired. I wonder if they went. I think when I bought them, they were like maybe a 2 or 3. They were the 2 or 3 person player in that industry, disk storage kind of technology. And I think it was maybe external disk drives, those things. So I didn't do much research. I just looked at the stock symbol and I thought, okay, it's storage technology. They do this. I think it's a pretty cool industry. Let me just try to go all in over here. And I put all my money in this stock. Actually, I had talked to my teacher. I said, look, this stock looks pretty interesting. What do you think I should do? You should bet it. Just do it. So I bet all my money into it. And turns out, throughout the contest, all my money, evaporated. And the company was going through a Chapter 11 bankruptcy. So
this is the best way to learn, right?
Yeah, with fake money. And I said, well, Mr. Knight, you said this is a great company. He said, you know what? It's your first lesson in investing. Do your own research, and always know what you're investing in. So that resonated with me for a long time. I'm glad I got that lesson early on. And before that, I had seen my dad actually, and he was buying these small companies, and was pretty intrigued by that too. He wasn't buying blue chip companies, although STK was a bigger company. So that was kind of in the back of my head too, a little bit. So then, along the way there, after that little lesson I got, and it wasn't shortly after that my dad gave me that Peter Lynch book to read. One Up on Wall Street.
And I read it more or less.
Excuse me?
At what age, Maj?
I think I was 19, maybe 18, 19, right going into college there, maybe really early on there. And I was in college not knowing what I wanted to do. I wasn't particularly a great student. And I went in there, maybe wanted to be a lawyer or something, make my parents happy. Although a lot of them are doctors and engineers and architects, but so I was there, and I was just not having fun with any of college at all, and wasn't really enjoying it. And then when he gave me that book, I remember it was a summer, I think, when I was 19, and my buddy at the time, his name was Ren Sminky. He's a really good friend of mine, best friend from back in the day, and we wanted to take a road trip together. He wanted to, this is, by the way, I'm in Pennsylvania now, Philadelphia area, outside Philadelphia. And I read this book, Peter Lynch, right before the trip, and I thought, this is a really awesome book. What if I can just make money off of investing? Because I'm not really good at anything else right now. So maybe this will work out. And so we're on this road trip driving from, up north, Philadelphia, which is near New York, all the way down south to Alabama, to visit his grandparents. One of his grandparents was ill, so I decided to go along with him. I think this is on maybe a Labor Day weekend, whatever. And so we're driving there, and I couldn't stop thinking about this book the whole time. It's a long drive. I can't wait to get back home and read this book. And so that's when I knew I was really fat. I knew I had something. I didn't bring the book with me. It was a long trip. We went to Alabama, then we went to, South Florida. We didn't realize it was a holiday weekend, so we slept on the beach for a day. I woke up with a pelican in my face, like telling me to get back to Philadelphia and read that book. So, we made it back home, and I read that book real quick again. I was like, this is it. I want to figure this out. And that's kind of how I was born. And I instantly, changed my major from, I actually hadn't declared a major yet because this was my first couple of years of college there. So I went to finance and risk management, kind of a dual major situation. And, it wasn't what I expected, because I'm just reading Peter Lynch's book about stock picking, right? And what you learn about what you're getting corporate finance, you're getting a little bit of the old fashioned investment theory kind of thing. And I wasn't getting, and everything you would learn was, okay, markets are efficient, stocks are, fairly valued. It's going to be hard to find cheap stocks. And that wasn't really appealing to me. I said, this can't be. Peter Lynch is getting 30% a year for 13 years. So my teacher was not a very happy teacher. Portfolio kept talking about how you can't beat the market, and told me I would never make it in the stock business. So that was it. So I said, I'm going to still do my class stuff, but I'm going to start doing some stuff of my own. And this is where I started really kind of finding, the resources. The really tough part, anyone getting investors, how do you take 20,000 stocks in North America? And how do you go through that list, right? And figure it out. And at that time, we didn't have what we have today in terms of the access to all these screeners and free tools. So I decided to go to, after reading Peter Lynch's book, he had talked about a resource called the Value Line. The Value Line is a publication. And I encourage all of your readers to, if you can get your hands on this. I don't know if they have a translation. They have a website too.
People know this place because many investors talk about that in the early innings. Value Line was the best for researching, right?
Yeah. It was great because, they would cover, I think, maybe thousands of equities. I think maybe if you were a listed stock, they would mainly cover you. I don't know if they covered nano caps though, or microcaps. I don't think they did, but they still went to the small cap area. And what was cool about the Valiant was this. So the Valiant was free, first of all. So I went to Temple University College, and I would access the Value Line there. And what was nice about it was this. Peter Lynch says, if you can't, give me your thesis with a crayon or really quickly, you don't know the story. You don't know the story well enough yet. And what the Value Line did was it was one really page of, here it is. Here's what the stock is. Here's what they do. Here's kind of what we feel about it. And they would rank the stock between on two scores. They would give it a timeliness score. Is the stock timely right now? And they would give it a risk score. How risky? So 1 and 1 was the best. 1 is safe and timely. 5s are the worst. So that was my first really tool there. And so but the next big thing was, okay, well, you got that. How do you still know what stocks to look for in the Value Line? I didn't want to go page by page and just look at rankings. I didn't want to be that because that's everyone will be doing that. And I wanted to kind of find some other way of doing things. So at the same time, I entered an investment contest, another fake one by USA Today, which is a paper here in the US. And they would have these investment contests. I think they would last maybe a few months. So it really got me into okay. And it was cool because you would actually call a live simulator broker, get on the phone, call a broker up. Everything was done on the phone. I think you can still put your trades in on the phone, but you can still talk to a broker actually. So it was pretty cool.
It's the same than Leonardo DiCaprio film, right? When they talk about pink sheets papers, no?
Oh, yeah. Well, I hadn't done the pink sheets yet. So I was still looking mainly on listed companies at this time. I hadn't even really discovered the small cap guys yet. I should have said I couldn't. Yeah. I'm still looking, more in the probably mid cap arena, maybe a little small cap. I didn't understand yet microcap, nano cap, big cap. I was taking the Peter Lynch's philosophy was, buy what you know. So he's like, if whatever in your daily life that you kind of connect with, whether it's if you're married, you have kids, you're active in sports, you go to the gym, if you connect with these products somehow and services, use that as your kind of hunting ground first. And at that time, so I used to play video games a little bit here and there. So I looked at Acclaim Entertainment, loved going to the movies. So Polygram Entertainment. So there were those larger companies I was investing in, doing pretty well in. But but the first stock I actually bought with my real money was Storage Technology. Wait a sec. I was curious. I look at the Value Line. I'm like, what's this STK? Storage Technology still around? And they came out of bankruptcy. And the ranking at that time in Value Line, I think, was maybe it still was maybe a 4 or 5 on the risk level, and maybe a 3 on timeliness. So I figured, I don't want to wait till it's a 1-1. And this is another lesson I learned. I want to get in there before the market finds it, and before the risk is taken out of it, right? Because the stock will go up to reflect the less risky part of the investment. So I just did a little research. I read the Value Line report, and at that time also, during this kind of time, I broke my foot in a car accident, so I had nothing to do, and I got a job. My buddy had a job at a brokerage firm, and he let me be an intern at his firm. So I would go there and they had these things called S&P tear sheets. You know those, Quim?
Yeah.
standard Force tier sheets. And they had more information on companies. So I had this, I was lucky enough to have access to this wonderful information that only a brokerage firm mainly had at that time. So I bought the stock, and I think I made like 30-40% in the stock pretty quickly. And what I noticed was when I had sold it, the stock had moved up maybe to a 3-2, a 2 for timeliness and 3 risky, whatever. So like, it'd be interesting. I want to beat the crowd a little bit. That's the next lesson. If I can find companies that are kind of timely, maybe a little riskier than maybe the market would like, I can get some good pricing and valuation on it. And if I can predict that the company's going to become less risky, right, and go into like an earnings growth cycle.
When you say sorry, Maj, when you say market likes, are you talking about 52 weeks highs, for example?
Well, I'm talking about just that investors recognize they like the stock, with however they find it. But now that you bring that up, so that I would start to look at these. I would start to track momentum stocks. So I wanted to find these momentum stocks that were starting to get attention. So these are stocks hitting new 52-week highs that weren't quite ranked really high yet on the value line, or even the Investor Business Daily, which is another common news publication here in the U.S., which is a momentum-based paper, right? So they rank stocks on their timeliness, I think earnings score, and institutional accumulation. So so again, ones are the highest in those things. And I guess, they had, I think, percentage scores too. Like, so the higher you get in percent, the better.
Yeah.
So I wasn't trying to find these stocks in the 90 percentile. I was trying to find these stocks hitting highs that might have still been in the 70 or 80% percentile on these things or less. And to see if I could see if these guys are going to eventually find these companies. So that's kind of how I got into the whole process. So the new high list was my list. So remember, we have this problem of how do you take 20,000 stocks and distill it to a list, right? So I didn't have access to a lot of screening tools yet. And I had this one, and they would send you a disc every quarter. So every 3 months you would get a disc. That's just too late for me. And all it would do is tell me everything's fairly valued. So I don't like that at all. So I decided, screw that. I'm going to start, really just doing my, whatever source of information I can get on the company, I'm going to get it and make my own assessment. And I didn't want to rely on, screening softwares. I wanted to rely on maybe calling management teams. So I started interviewing management very early on, even these bigger companies, which was more challenged than I thought it would be, but it was still possible. So the new highs were easy for me to get. I could go to the Wall Street Journal with the Barron's, and I would handwrite these highs every day or once a week. I would go every Sunday for 5 hours. I eventually got an office because my dad was getting sick of me in the house. I'd actually worked at Vanguard for a while, which is a mutual fund company, and you might all be familiar with that. And this is an interesting period of time. So I'm going to fast forward and go back a little bit. So I come out of college, after getting a little bit of introductory kind of to the stock market myself, but doing things. Get out of college, and I didn't know what I really wanted. I still didn't know if I wanted to be a full-time investor or a broker, although I was making money for all my intent purposes. I was a full-time investor already in college. I was really investing my money already, even though I had side jobs and stuff. But then I figured, let me get some experience. Maybe I want to be a broker or a fund manager or something. So when I was doing the internship for my friend at the brokerage firm, at that time it was Dean Witter, his name, and they were acquired eventually or merged. And I don't like this. I don't like the cold calling, and it's not. You're basically. I didn't want nothing against it, but that wasn't me. I'm not really a salesperson, and I was really loving the research part of investing. So then I thought, maybe I'll become a hedge fund manager or a mutual fund manager at that time. So I worked at Vanguard. And it was real close to me. So I went there, and for the first year I was working full time there, and I was just answering phones, just answering questions about the mutual funds, and trying to assess people's what funds they might want to have. You couldn't give advice, but you could at least direct them. So it was kind of okay, and then I realized that it was after having reviews with the managers there and stuff, it was going to take. They said, it's going to take you can do money management here, but it's going to take you a good 5-7 years to get to that point. And I wasn't going to wait that long to start really you really have a stock picking career, whether it be on my own or for a company. Now, while I was at Vanguard, so when I realized that wasn't going to be my card, I said, you know what, I'm going to go part-time at Vanguard and start working like they had a cool shift, 4:30 in the Eastern time, 4:30 p.m. to 10 o'clock at night or 9 o'clock at night. So you got full benefits. So for me, it was like, wow, I can basically now go get an office close to Vanguard, get all my quotes set up, do that, then at 4 o'clock, head over to Vanguard. So it was great for me to have both jobs while I'm still saving some money. I wanted to save, $20,000, $30,000.
Which year is running at that time, Maj? Is before or later than the bubble crash?
So they give you time frames. That's still basically, so that is probably, let me see. Yeah. 2090, when was that? Well, let me think that one that was 1994, 98, 88, 92. I'm going back here. So 92-ish. 92 is when I basically graduated from college. And then I worked that first year, basically, after, not right away, a little bit out of college. And then 6 months went part-time. And saving what I would do, by the way, when I was working full-time, when I figured this wasn't going to go my way, I would use all my time at Vanguard, like lunch breaks for an hour. I would go interview management teams. I would do research. I would do everything. I actually got in trouble. I was during a lunch break. I was in a conference room interviewing a company, and the co-founder, or one of the not co-founder, Mr. Brennan. He was the next in line to Bogle to take over the company. He came in there with a bunch of people, like saw me there interviewing a company, like, get out of here. So I got in trouble for doing that. And then I would go to use other phones. They shut down all the phones at Vanguard to me for employees to use, because I was just out there really, really kind of soak it all up, just learning on my own, because I wasn't still getting what I wanted to do on at Vanguard. So eventually I just left. After 6 months, of working part-time, I was like, this isn't for me. And I made that decision. I saved some money up. And I said, I'm going to get this. I'm going to get the $20,000, $30,000. And then, I figured that's what I would need right now. And I basically left in February of 94. I doubled my money in the first month, out of that. I was like, this is the right decision. And I already had found some, started investing in the smaller companies because of my dad. I watched my dad. He had some big winners, Numerex. I'm just symbols on top of my head from back in the day. This is still in the 90s, right? And wow, this is interesting. This isn't IBM. This isn't Intel. These are small companies. And I'm like, I said, Dad, where are these stocks? I don't see them in the Wall Street Journal. Well, then the Wall Street Journal did have a space for these OTC companies. And now I started looking at the new highs over there and started opening my eyes to those guys. And even the small cap and Microcap on the regular exchanges. I stopped looking at the big ones. And, it was easier to get access management. It was more fun investing in these smaller companies and finding out about them. And, if you could find these companies at the right time, you can get multiple quarters of growth and earnings and sales. And have some really big winners back then. The market was a little different than it is today, and how stocks would react to some of these news and multiple periods of growth. We can get to that later, actually. But so that's kind of the beginning of my career there, and it really worked well, man. Since basically that time, I just went deeper and deeper into nano-cap and Microcap. Really, I invest in nano-caps.
What do you remember from the tech bubble? Because you are invested in microcaps at that time, right? So what do you remember from that year? 1999, 2000?
It was nice. Luckily at that time, my expenses weren't dramatic then. I had just bought a house, but it was,
I like to be at your home, listen to your father to say, Maj, what are you doing to invest in these stocks that are gone down 80%, right? So go to IBM or the big stocks, right?
It took him a long time to even accept that I was going to do this for a living, But then he realized that's what I was good at, and he soaked it all up. But yeah, he was not, the happiest about it. And look, what I could have done better in my life, this is very important, I think, to your listeners, is I wasn't say I was a cocky or egotistical investor, but I wasn't necessarily. I knew how to find stocks. I knew how to interview management teams. I think I knew how to pick them and value them and understand what made them go up and find them at the right time. But I didn't do a lot of assessment on risk. How to protect your portfolios or how to risk manage your portfolios. And that's something I didn't. It took me years to really understand. Maybe I should look at that. And so, in sell discipline, I didn't have the best sell discipline. I still hold on to stocks probably longer than I should sometimes. And so that's something that, I would really encourage young investors to, when you start out investing, just try and think of a plan where you're investing your money and then you're thinking of buckets. When you make money, always, putting money away for taxes. When you sell a stock, putting away money for the rainy day. Put away money for, the rainy day means if the stock market falls really hard, you got some money to spend there to buy stocks on cheap, like now. Put some money in your rainy day fund, which is like, if you have emergency expenses, you need to tap into, and then put some you just don't do anything with, just saving it, and maybe eventually buying real estate one day with that. That's always been planned, to make money in the stock market, but build wealth with real estate. And that was kind of the path I led to some degree, but I wasn't the best in all the buckets, because the worst thing you can be in this thing is to make all this money, then tax time comes, the market falls, right? Especially if you're a full-time investor. This is really important with full-time, or you're kind of part-time-ish. Is that it's the worst feeling when you got to pay taxes and the market's falling and you haven't put money aside to pay your taxes, right? So now you're forced to go in there maybe you get margin calls if you're on margin, have to sell stock that you love to buy, you pay your bills and stuff, or to pay your taxes. And that's the toughest part. And that means sacrifice. That means, like, when you are selling stock and putting it aside, you're going to basically, not going to be able to buy some stocks you might want to buy, right? For me, that I would still put in real estate was my bucket. I would put a lot of my money into. I should put more money in those other buckets too, but initially didn't. But at least I got that right. So I mean, I would really, and I would really, I just understand, what sell discipline is. Don't be afraid to sell stocks when they're going up a little bit and taking some money. Is probably the best way to look at somewhat, this. But now, I am a true believer though of holding stocks you love for a long time. And that is, I don't want you to think I'm this trader guy over here, but you have to balance it. If you can put yourself in a situation where you're financially stable outside your stock investing life, that you've got a great plan within it, you can hold stocks longer and hold the volatility, right? That's the key, is you want to be able to ride out volatility. And that means not only having the financial strength, but making sure that you're emotionally able to do it. It's very hard to be emotionally stable when, you got a bill coming up and you got to depend on your stocks to pay that bill. You start making irrational decisions. You're going to sell at the worst possible time, and it's going to make your wealth building process a little harder.
I will say that retail investors has an advantage against professional investors, because if I have a big drawdown, I have to talk with my shareholders and my investors. So the retail investor don't need to talk with anything. So just with him, right? So it's easy. Right. So Maj, if you want, we can advance until 2007. That I think this is the time that you start to create GeoInvesting. So could you talk about why you decide to create or co-founded GeoInvesting and how it goes from 2007 to the next years?
Yeah. So look, along this, when I was doing this early investing, and it was just me doing it, and for myself, I was starting to amass like an email list of people who I would just send my stuff out to. I wasn't getting paid for it at all, friends and family. And I would follow the pure lunch approach. I would send an email out, every once in a while with 5 reasons I like a stock, 1, 2, 3, 4, 5. And that list started getting really big. And then I said, you know what? Let me, this is getting a little burdensome. There's probably some value in what I'm doing to some degree. And I'd like to start, meeting other investors in the nanocap space and building a network. So I'm already doing the research. So, why not just put it on our website? So that's basically where that came from in 2007. to do that. And it was not a subscription-based website. At that time, it was a free website. And did that for, I think for the first 6-7 years, we didn't charge anything in Geo. And then eventually in 2014, I think we began doing a subscription-based product. So that's kind of the evolution, how it started. When I first, thought of the concept of GeoInvesting, it was me, my brother, talked it over a little bit, and we're like, we wanted to be this, find great quality stock. We do quality research on the nanocap space with a little speculative flair to it too. We would have some speculative stocks here and there also. And along the way, I was also investing in these U.S. listed China-based companies, and not a lot of them at the time. So I think I first started finding these stocks around 2005-06. They would come to the U.S., the ones I was finding at least, because I'm looking at smaller companies, through reverse merger. They were trading on the OTC. So a reverse merger, I don't know if your listeners are familiar with it. It's just a backdoor approach to going public. So you basically go to instead of going to an IPO through a brokerage firm, initial public offering, where you sell shares to the public through a brokerage firm, a reverse merger, you go find this OTC company that's not maybe doing anything anymore, but they still have they have a value because they were once listed on the stock exchange maybe, and they have this entity that trades still. So now you just go buy that shell, you buy it, and now you're public. So that's basically, so you go buy the shell, maybe raise some money in a private placement, and you're off and running. So my new high list I was looking at, would and by the way, this new high list I had it for years. It was all for many years, it was all manual. I would write down the symbol, the stock price, the PE ratio, some notes, and that was really it. And I would always go back and look at it. It was very antiquated. So in 2005 or 6, I hired a programmer to basically create my process that I would do on paper and make a program out of it. And so now he created a software program for me, which I still use today, and it's what powers GeoInvesting actually, which brings in all my highs of even OTC companies, which is awesome because a lot of entrepreneurs want to do that. So that's what I still use today for my momentum. Now I also I use other. We'll get into the process later. So I don't just do new highs anymore, but that's a big part of it still. So so these Chinese companies would start popping up on these new high lists. I'd start researching them. Like, wow, this is incredible. Growing at 40% a year, PE of 5. That's great. That's really cheap. And I don't got to now. I don't have to invest in China. I can just invest in the U.S. I don't got to invest in Hong Kong or anything over there. So I don't got to worry about that at all. Figuring that out. So now you start buying these companies. I started couldn't believe these numbers. I would read the SEC filings. So I started buying these stocks. I mean, not like in droves, but I would start adding them to my portfolio here and there. And what I noticed was, then eventually we started GeoInvesting. We started slowly highlighting these companies on Geo to our free members for a while. But what was frustrating was that one thing that never happened along the way was the valuations of a lot of these companies I owned were not expanding. Even though we're growing nicely, the PE ratios were still staying at really low PE ratios, and price to sale ratios were low. It just didn't seem right. I understand they're in China, but that disconnect when you're growing at 40% a clip for a long time, and you're only selling a PE 5 or 10, and you're in this high tech industry, something doesn't make sense. So in 2010, I got a call from somebody. He just got out of college. I think he was 22 at the time or something. And he said, "I love what you're doing. I'm also love the nanocap space. I'm also really interested in these China stocks that I see you guys write about." Because we were write on Seeking Alpha a lot at that time too. We would do publish on our own website, but also publish our information on Seeking Alpha at the time. And so he's like, "Maj, send me to China. And I will look at these companies." And at that time, I already had started putting We started putting together a on the ground team in China. We had a PRC. We had a lawyer here in the U.S. and he had great contacts in China. So okay, so I gave him 50 companies. We chose together, and I'm gonna have you go to China. And this is, I think, maybe July of 2010. And we were making a lot of money in these Chinese stocks, by the way. They were, even though they were not getting the real huge valuations, they were still moving to keep their valuations, and they were doubling and tripling in their numbers. So after 2 weeks, he calls me and says, "Maj, they're all frauds. None of these companies are real. I mean, 80%, 90% of these companies are not real. And if they are real, they have very, very shady relationships that you can't explain, related party relationships, self-dealings, where's the money going?" And we immediately put a note out to all of our members.
So too much red flags, right?
Too much red flags that we couldn't explain, account receivables, that couldn't, they're way past due or out too long out there. Just, it wasn't making sense, right? Couldn't verify customers like you wanted to verify the customers. And then more importantly is, while that's going on, my PRC lawyer is starting to pull these financial filings in China. They're called SEC financials filings. And each province that a Chinese company does business in, it has to basically file these set of financials with a local branch of this agency, right? And so we started accessing these filings. And now the reason we started doing that, around this time, you started seeing some short sellers come out and start talking about these companies and these filings. So we started getting these filings, and we could start looking at the numbers that were being filed in China were not anywhere near the numbers that were being filed in SEC.gov documents. So the 10K in the U.S. might be 80% overestimated versus what was really going on in China. And that was crazy, right? So, and then, but not only that, these SEC filings. So what would happen? So you would get pushback. So the analysts in the U.S. who are covering these companies and the companies themselves would say, these differences are based on different accounting standards in the U.S. and China, right? But that's just way too much of a difference. But more importantly, you could also in these filings track other things besides the financials, like ownership structure, and all these things. So you were able to see, okay, in the SEC filing, the company says it owns this, this, and that. Well, in the SEC filing in China, it says they don't own it, they sold it, or they never had it, right? Then we would go find the real owner of the asset, who would say on recording, "No, these guys don't own any. We own this. They never owned it."
Maj, one question. That companies at that time, they was obligated to report the same information in the US than in China, or do you have?
Well, they weren't.
A lot
that was the problem. They weren't. So basically, in the US, they would report the SEC filings with the SEC to 10Ks and 10Qs.
But a small 10K, no? So you can find financial statements and maybe some 3, 4 pages, not more, right?
But you can find everything. They would get very detailed here in the US. You would have the 20F. It would either be a 20F, which is an annual filing. Some of them actually had quarterly filings, but they were detailed information, sure, which made it look more legitimate, right? Because they were very detailed financial filings. And then on the China side, you could get access to not all of the financials that they filed in China, but you could get enough. You could get the sales, earnings, cash. You could get maybe some, equity and some balance sheet items, and start seeing that those items in China, when you consolidated all of them across all the provinces for a company, were not matching the number in the US by a long shot. And the analysts didn't care, the auditors didn't care. No one knew what to think because, the regulators are in a tough situation because the auditors already gave a stamp of approval. The attorneys gave the stamp of approval, right? They have IR firms that are pushing these stocks. So the regulators are in a tough decision. They just can't blindly accept or agree with a short seller, right? So it was really a tough period because, you had these, no one wanted to believe it. Then it became like, well, maybe 50% are frauds. Well, no, maybe 80% are frauds. Maybe 90% are frauds. And it got higher and higher. And so we did a lot of on the ground work in China. So around that time, unfortunately, when we're doing this, we're still doing a lot of work in the U.S. by looking at very good quality companies in the U.S. that we liked a lot here, the nano cap sector. But GeoInvesting became known for shorting China for a while because that was much more sexier, and you would write these long reports. The stocks would go down like crazy, and then eventually get delisted and halted by the SEC. Halted by the exchanges, and they delisted by the SECs, or registration revoked. So it was definitely, and you had a lot of like high brand, well-known funds like Paulson, for example. They're investing in these companies that are getting busted by like Muddy Waters and all these companies, right?
Yeah.
And that ended up being like, proven frauds. So we became for a good 4 years, from 2010 to 14, we wrote a ton of research on a ton of companies, but specifically there were about 12, I think, deep dive reports we wrote, and all of them went to zero basically, shortly after, eventually after we published them.
I remember the China Hustle documental that they talks about your company, but also they talk about Moody Water. And there is some funny history that I think is an analyst of Moody Waters that don't understand the numbers, and they decide to travel to China to check some company, right?
Yeah.
And I remember that guy arrived at the door of a manufacturing company, right? Big manufacturing company. I think thousands of dollars from revenue line, right? And when they arrive at the door, they can see any movement about cars, tractors, something like that. And they start to talk with the guard from the door, right? And say, no, it's anyone is going in, anyone is going out. So here it's nothing happened, right? So and this is how they start to think that this is a fraud and that's not real, no? I suppose it's the same than you, right?
Yeah, it was amazing. I was amazed at the information you could get from a security guard, or like the store next door. Nothing's going on there. No one's there. It was pretty amazing. I didn't believe. I didn't there's no way these guys are going to know what's going on, and they didn't. And they knew what was going on. So that was a lot of our due diligence was going on the ground. So step one was checking the filings. Can we get all the filings in order? If that doesn't make sense, we got a red flag here. Then we start looking, on the ground, interviewing, neighboring companies, going to the company itself, interviewing maybe the front desk person, verifying the customers. And then the cool thing about these SEC filings is you could so if a company said they owned a company, well, you could go through this whole chain of events, even though they might own it, you could check the whole ownership structure, and you would find like all traces back to maybe the chairman or CEO owning the company that they bought, right? Just to get money out of the company. That happened a lot. So that was basically, it was really, there was one company that claimed to own a cemetery land, right? Cemetery plots and stuff.
Yeah.
We actually went and bought a couple cemetery plots, got the receipt to show that it wasn't the company who owned that land. So we did all these things to prove it. And what was really frustrating about that time was that we tried to work with investment bankers, and we tried to work with IR firms, and even auditors and stuff, to say, like, let us be your research arm. Let's go find these companies and tell you which ones are real and which ones aren't real. And we actually got, a few to say yes initially. And then when they said, okay, if you prove us wrong, we'll definitely drop these clients or make some kind of statement. And what would always happen was you would put the due diligence on their table, but then they would continue to believe the company's narrative. The company would always talk its way out of it, right? They don't know what they're talking about. That's how things are done in China. And so when that occurred, when they stopped not wanting to work with us, that's when we decided to go short and start making money shorting stocks, or trying to, at least, in building that business. And so that, went on for a while. And a lot of it was probably about 90%. 90% of that space maybe blew up. And it was really a tough time. And even today, there's still fraudulent companies out there, and
Yeah.
in the U.S. That's amazing. It's now the fraud's more sophisticated. They're actually larger companies, the real companies, exhibiting fraud. And
I have a curiosity here. So I'm using the Edgar database where I check for SEC letters about companies and SEC. At that time, can you find this information with China companies, or it's only for US companies?
you're talking about the SEIC letters?
Yeah.
So the SEIC, you only can get it from China. So you had to have a lawyer contact in China to go get these filings.
Okay.
And now what they've done now is they've made it, Chinese government has made it much harder to get the filings, and much less information is in them. So it's much harder to, prove it, and they can fake them, I guess, too, at this point.
Okay. Great history. So go to the second part of this interview. I'm going to have questions for you. The first one is direct. So what is for you a quality nano cap or a quality microcap? How you define a quality nano microcap?
Yeah. So look, we have what we call tier 1 companies. Right? So so our research buckets have strategies across the quality spectrum, right? So we eventually want to be investing in a company that already meets our tier 1 quality checklist, which is about 10 points, or moving towards that. So remember what I said earlier about trying to find stocks that maybe aren't pretty yet. Maybe they're 3 threes, 3 quality, 3 risk, and that can move to 1. So, we're trying to find these companies that are already high quality and being ignored, or have a chance of getting to the high quality. So when you look at this 10-point, let me see if I remember them off the top of my head here. The first one we like is, of course, we want these companies that have been around for a long time, maybe 20, 30, 40, 50 years of history. And they've just been sitting around waiting for something to happen. They've proven they can operate during different types of environments. But maybe time has passed them by, though, right? Maybe they haven't changed with times or done things to improve the company. And typical companies like that would be a great company that's been around for a long time that really hasn't introduced new products to its current customer base. So maybe you can right away grow 20, 30% by introducing new products to your customer base. So we're looking for these kind of things. And what will happen oftentimes in these situations is that if the old management team is not motivated, you get maybe a new team to come in to catalyze it, or people within the organization get promoted, to that they're younger and have more energy that want to do something there, right? So actually, we just interviewed a company in GeoInvesting, I think it was last week. It was just like that. It's been around for a long time. The old CEO just was content with staying at the same level of revenue, serving the same customers with the same products for many, many years. The new guy comes in, and he says, "Look, he used to work for the company, and he was in the design. It's a tech company, but they make materials to help technology applications work better, or solar, just anything, solar panels work better, just whatever it might be. It's very, very broad. So what they decided to do was, okay, well, look, we're going to go to our current customer base and see how many other ways we can serve this customer. So maybe it's a customer that we've been supplying for years has 3 or 4 other divisions that we can help. And it's not a very hard sales proposition, because you're already with the company, you already have trust. So that was number 1. And number 2, he's like, okay, let's also try and find markets that are less volatile that we can go target, what they call mission critical markets, aerospace, some defense, high security, these kind of things that are always going to be in demand throughout different cycles of the economy, right? So that right there is what we call wallet share. Wallet share is when you get more money from your current customers, and then expanding markets to like, to more predictable growth areas. Those are just two multi-bagger traits that work over and over and over again for these tier one companies.
Yeah. Do you think that, I think with this first part, with the management change, which is the better to change the dynamic, I think Repromet systems could work in that time, no? Because Linda is working really well, and I think it's doing the good job to try to change the dynamic. And for the other side, for example, Altigen is trying to increase the recurring revenue business. This is totally different than selling a license or selling hardware. So this could be two examples of this management change. What do you think?
You're looking at two companies that I own both ATGN and KRMD. I've owned KRMD since 2007 or 8. I've owned ATGN since 2015, and then those are both classic examples. ATGN more so, because ATGN was a situation where it's a I guess what we call it, a cloud telecom company right now, basically. So
UCaaS, communications in the cloud, right?
Yes, that's what it is now. So, but prior to Jeremiah Fleming becoming the CEO of the company, maybe 2010, can't remember if that was quite the year, but the old management didn't see the cloud as, or UCaaS as we call it, Unified Communications as a Service, as a model. So they were basically just selling hardware kind of phones and hardware and related phone systems, like the phones, and related hardware to companies to be able to build their infrastructure on premise, right? All the networking coming and everything there. What Jerry did when he came and said, this is not what we want to do. We want to offer an off-premise solution. We basically want to be able to have companies be able to host their, we want to host it. We want to be all the infrastructure. All they got to do is connect with us through the cloud or, through software, and we'll take care of all that stuff. So, and now so that was the move he made, and it took him, a good, he's in this a long time. The transformation really began in 2015, early 15 when I bought the stock. And they've been going towards that, cloud communication type of transformation, being a UCaaS provider, full force. And I think right now that we're on the subject, I think they're at an inflection point right now of growth where things are going to really pop for them.
Okay. How do you screen for management change? Because with the software that I'm using, I can search for change in the CFO, CEO. I can say, okay, I want CEOs from they bring 10 years in the same company. They have a bachelor in mathematics. So I suppose that you have a screener, then you can separate, or you can advise when there are some CEO that goes out and new management that goes in, right?
Yeah, we use Sentio a lot. Our program we use here is Sentio, is the in-house thing to help do that.
Sentio.
Yeah, Sentio. It's really good. I could probably get you, if you guys want to try it, I can probably get you a preferential pricing on it because of the relationship we have with them. But
okay.
But a lot of it, you'll be surprised that because I know what I'm looking for in a company, right? So I'm not necessarily looking for management changes first. I'm looking at stories and press releases, and I'm really saying, okay, does this press release have a lot of the story that I'm looking for? Or I'm looking at the filings too. So if the stock hits a new high, that first comes in for me right away. Then I go look at the press releases and the filings to see if a lot of these qualitative factors are meeting some of my requirements, So I don't do a lot of it screen, but it could work. It basically comes as where do I want to start my research, right? Do I want to start by looking at the management changes, or do I want to start by looking at the press release, the new high, and going from there? And I mix it up a lot.
Okay, so you talk about long life, like 10, 20 years in operations, looking for management change, looking for press release that you can identify management change and other things, 52 weeks highs. What more is a quality microcap for you, Maj?
Okay, so when we go on to this, the second major requirement is we obviously want a good management team. It sounds obvious, but we want a team that understands the industry, the products, the customers, that's focused on growing the company, not necessarily stock price. And sometimes these companies have been around for a long time, have great teams still in them. That's fine. But it's really important for us to look at that track record of the current management team and how they and the kind of success they've had. Well, I like a lot.
How do you rank the track record? So how do you understand the track record? So are you looking for capital allocation? Are you looking for transactions? So how do you understand if the track record is good or is it bad related to the management?
Well, you're reading the bio and you want to make sure that the biography matches it. So I'll learn about the bio by looking at the SEC filing and then cross-checking it with other whatever sources I can do to verify it. But then you're going to call the company up, and then I'm going to interview the CEO. And really, that's where a lot of, I think, some of the skill I've learned over time is how to really connect with CEOs and have them tell me their story. And through that, it's hard to give you a cookie cutter approach to it, but through that storytelling, you can start to understand. And some of the key things I ask in the interview to understand a company, a management team's ability. Obviously, you want to see whether they had successes in the past and what they've done, right? So one company I'm investing in right now has a new CEO who's come into a tier 1 company. In his last company, he took it from 0 revenues to 400 million in revenue in a few years, in high EBITDA margins. So I'm really happy about that, right? So, but then I'm like, okay, well, more importantly, I want you to tell me, because nobody's perfect. I want you to tell me the mistakes you've made as a CEO or a past, C-level suite manager or whatever you might have been doing, founding a company. What mistakes did you make? Why did you make it? And how were you able to come back from it and prove to me you did it? And that's really important to me. I love CEOs. By the time I've got to them, that they've made some mistakes already. So they'll make it with me, And one of the biggest areas I see that in is the sales and marketing. Is that seems to be a area where a lot of missteps are made. Either they've done, and product development. They made the wrong product, or not, maybe the product wasn't what they thought it was going to be. So did they come back and improve the product and have success? What did you come back and fix that sales process problem? And that to me is really important, because the sales process in the end is really, you need a little selling. Marketing is so important. I don't think enough people ask that question in interviews. Like, what's your marketing plan here? Or, how are you going to do this? You can have all great ideas and great products, but you can't market it. What does it mean, right? And so that's where I see a lot of, I like to see how management teams have kind of suffered through those cycles of sales processes. They haven't worked out and how they come back through them. But really it's about, so I really want to understand, and then you just ask them questions. I like to understand, are they focused more on margins or revenue growth? What do they want more? Generally speaking, I'd rather have a company in most situations that wants to maximize the bottom line. But look, there are some situations, like you're a SaaS company or a software company, where revenues are really important. So I'm looking for so in a software company, for example, I'm looking for a management teams that wants to grow, revenues aggressively, but still wants to stay at break even to profitability right around their level. So that's, so each company is a little different, Quim, right? How we look at things. But yeah, so I'm looking for that. And that's probably like, the biggest question. Then you're just going through, I like to know what their capital allocation strategy is. Do they want to raise money just to raise money? Do they value shareholders and maximization shareholder value? Dilution. I hate dilution. And I get a little bit worried when a new team comes in and wants to start acquiring companies and raising money, but that really is, I don't want to hear a CEO say, I want to raise money just for liquidity. Because you'll hear that sometimes. We want our stock to be more liquid. I don't care how liquid your stock is. If nobody wants it, doesn't matter anymore. It's all going to be the same. So just grow your company, make smart acquisitions, and investors will eventually find your company. I don't care if you have liquidity, not liquidity. If you fail, your stock's going to go down. Doesn't matter. If you succeed, your stock's going to go up. And maybe less people can buy your stock, but who cares? It's all about creating value for your company in the end, right? And to me, it's not about creating liquidity. And I like to, management teams to understand that to a degree. So that's really like, important there. Actually, if I have, let me pull up I did a nice little article on this.
We have some questions, but I want to talk about later at the end of the interview, okay? Because people is asking some things. I want to talk later about revenue and margins. How do you project these numbers? And what more attributes are a quality stock? You talk about the management, the long life, revenue growth, margins, capital allocation.
Yeah, let me go through the first. I'll go for those 10 for you. Okay. So we had one, the length of management, right? Number two, we just said was you want a good management team, right? Number three, we're looking for a management team that looks at the stock. Is more interested in the company than the stock price itself, not focusing on the stock price so much. Number four, we're looking for companies where management has, a decent size of insider ownership. Number six, we like to see companies that are generating some revenue, at or near profitability, strong balance, a strong or an improving balance sheet. Not a lot of shares outstanding, and has a history of buying back stock maybe, or not diluting too much. So those are that kind of the 10 criteria we kind of look at there. Now we want them to move to that, and I don't want people to think, okay, just go to this checklist, and the stock doesn't meet all 10 of these checklists. It's not good. We want everything to go in that direction. So if a company has a lot of debt, which wouldn't meet that checklist, but they have a way of reducing debt, maybe by selling some assets, right? Like one of the stocks we bought a while ago. I mean, we don't have any more. BXC, Boy X-Ray Charlie, Blue Links. It's a lumber supplier to the home building industry. Was one chapter almost went. I think they almost went bankrupt in 2008-9. We found the stock around $8 in 2017, I think. Went to in one day it basically popped to $40. It was after they made they were reducing debt, made an acquisition, the stock popped. So I mean these are all it's you're gonna get your best gains. I mean if you can find a company that meets all 10 checklist marks and it's cheap, that's great. Of course you want that, but you're gonna sometimes get your best value proposition when you find the ones that aren't there yet. But they all have to be moving in that direction, right? In those areas.
I think we share one rule of this, that searching for companies that are in an inflection point. So they are in losses, but they start to decrease fixed cost, and maybe the operating margin and net income margin starts to go up, or they bring, 3-4 quarters, 1 year doing this different. So I like to match this kind of companies. I think you agree with that, right?
Yeah, I love that. Man. Finding those points of, we have this thing we call GPR at GeoInvesting. I used to use it a lot. Geo Power Ranking. If we can find stocks where they're going to get at least 5, 6, 7 quarters in a row of great growth, you can get some really nice short-term. You're finding that could be at the right time, right? So I love doing that. I did a lot of that when I was younger. All this, what you're talking about, this catalyst investing, I guess you would call it. But yeah, I'm with you on that, man. We're just trying to find these changes. Changes is good, right? And even the great companies go through change at some point. If you can find these pockets, like when you have a company go from 1 to 100, there's pockets of that might take years and years. So if I like to invest long term, but I would love to find these pockets too. If I can find a stock that's multi-bagger status, like it's finding a point in that chart where is really in some inflection point going on where I can capture a lot of gains there. Sure, I want to find that. So absolutely, man. And it's
Last
fun.
week I
it's
was
more fun too.
Last week, I was making some brief at my home, right? And I said I'm reviewing all my errors, investing errors, and most of them are totally different than to buy a company in an inflection point. So all the companies, or most of them, maybe 90%, all the companies that I bought in this inflection point, they are good winners. And my multi-baggers, all of them was with this kind of style of investing, right? So I think this is good. Okay, go. I like to talk about revenue growth and margins. Okay, do you know that I'm doing a live course in equity valuation? That the course is finished yesterday, and I spent too much time in the course talking about key performing indicators. So, for example, in my fund, I don't like to invest in cyclical stocks. Okay, but also, I don't like to invest in companies that the management are not telling me some KPIs. For example, if one company it's telling me, okay, next year I have a revenue of 100 million and my margin was a range of 9 to 10. If this is the guidance, I don't like to invest in these companies. I like to invest in companies where I can estimate with KPIs the revenue number. For example, if it's a steel company, I want to know the production of steel, the volumes of steel, the average prices. If it is a technology company, I want to know the number of users, the number of subscribers, the number of the average revenue per subscriber, this kind of things. I don't know if you use KPIs you are not using. Could you talk about how do you project your revenue number?
Yeah, I was waiting for that question because, yeah, it's look, there's definitely certain things I'm looking for, right? And of course, it depends on the company I'm looking at. So if I'm looking at a software company, I want to look at the average revenue per customer versus the average cost to acquire that customer, right? So these kind of things. You want to look at churn rate. What is the average time a customer staying with a customer, right? Average time a customer staying with a company. Sure. But I don't do a lot of revenue forecasting. I do a lot of what I try and understand the story to a point where do I believe it's going to be a lot bigger in 3, 4, 5 years to myself, right? And do I think I'm paying a decent price for it right now for some of these assumptions I might make?
Maj, I cannot hear you. The audio is off.
You hear me?
Yes, good.
I put it on mute. I'm sorry. What part didn't you hear?
No worries.
What was the last thing you heard there? You hear about the average.
So you said that I'm using KPIs, but you said that you don't really to focus too much in revenue. Maybe you are focused in trying to calculate total addressable market and to try to fix where is the opportunity. Is it right?
Right. So I'm trying to figure out like I guess in some areas of software companies, I'm looking at certain things. There are things you want to look at, churn rate, the average cost to acquire a customer versus the average, revenue over the lifetime of the customer, these kind of things, and how those things can improve. And I like to ask the company where they want to be in those situations. But yeah, I'm looking for, really, and do I think a nano cap company I'm looking at, which probably has a very small market share, has a chance to gobble up a big piece of that market share over time? Can they go from a 1% to a 5% or, a 10% over time? And if I believe that can happen, I'm very happy about that. I can make the assumption they're going to grow maybe 20, 30% in the revenue or something. And after I'm comfortable with that kind of assumption, especially if there's something, they have, if I'm looking at a company with a small market share with, let's say, I'll ask the question like this. I'll say, okay, you have a customer right now where you're, how much of that customer are you not targeting yet? And they might say, well, we're 50% under penetrated. Okay, so I can start to get like I can start to get an idea of what kind of revenue growth I can put in there, right? A little bit, and that they can maybe, have a nice revenue from just that, So these are things I look to. So once I've decided that I've seen, okay, that I'm comfortable there's going to be some, at least 10 to 50% revenue growth in this opportunity in this company. That's my minimum I look at. I ask myself, more important to me is the operating leverage. How much expansion in the margin can I see? Not only the gross margin, really, I'm the operating leverage on the operating income. So if sales go up by 10%, can earnings go up by 30, 40%? Because then you can have what's awesome about those stories is you can have 15% revenue growth and really big moves in earnings per share for a long period of time on this steady growth. And it's growth that the company can manage, right? So if you're doubling your revenue all the time and you're going crazy with revenue, that's not always easy to manage for some companies. So I'd rather see this reasonable revenue growth with unreasonable expansion of margins, And that's where you see multi-baggers all the time are born there.
That sounds good, but operating leverages when the cycle goes down works in the opposite side, right?
Sure. So it depends where I look. It's like you, I don't like to invest in companies where that's a risk, right? So more and more of my investment strategies going toward these recurring revenue companies. Companies that can just either recurring revenue or repeatable customers, where the customer just stay around. I mean, maybe not recurring per se, but the customer's there year in and year out, and you can sell more products to them. Then I'll go look at maybe the past 20, 30 years of revenue and see if there's any kind of cycle of cyclicality with the economy. If there isn't, I'm not too worried about that, right? So I'm not right now, I'm not investing in steel companies. I guess I could, but and they're probably going to do well for a long time because the infrastructure, bill here passed in the U.S. But there's just certain companies I'm not going to invest in because I'm not going to be able to predict it better than most people, probably. That's not my style of investing, right? Now, you probably could. I'm saying, you probably could, if you're investing in a home building company, you could probably get all all these metrics that feed into the industry and try and figure it out before people smarter than me do. But
I know one that I like too much in home building. It's LG Homes. So I was investor of that company from last year, and this is amazing. The run up of that company was amazing, and I like because that company provide too many KPIs, like number of communities, number of units that you want to sell at the end of the year, the average price of the homes that are selling, the number of so too many KPIs that help me to project the revenues, right? So in terms of cost, do you used to spend time thinking and investigation about the cost? And do you like companies that they are in a process to decrease or to maintain stable the fixed cost? And also, second question, do you like, well, I suppose if you like operating leverage, you don't like companies with some percentage of variable cost, that when the cycle goes down, they can decrease this variable cost and margins are more stable than the other companies. I like this kind of companies.
Yeah, I like it. There's a degree of it, right? I mean, look, there's some, I want a company that can be able to, when I say operating leverage, I'm looking at more permanent reductions in costs, right? So there's some situations where a company can permanently take cost out of its infrastructure, right? So that when the market does turn, it does not mean that their costs are going to go up. So they might be doing things more efficiently to get better gross margins. Maybe they've upgraded their manufacturing facilities, so they just have better, margins in their gross margin permanently. On the operating expense side, maybe they've just taking out some unnecessary fat that doesn't have to be there at all. And so that when the sales do come down, we won't see expenses go down necessarily, but you won't see them go down as much, right? Because they've taken a lot of fat out. But look, when you have that's the risk you run when you have less variable cost, right? And you have this fixed cost nature, that is the risk you take. That's why I think it's really important to be able to invest. Really, the answer equivalent to this is I'm looking for companies that can grow through all types of environments if I can find them. That's what we want to find in the end, right? And then if I'm wrong, I want to make sure that if they do go down and the fixed cost nature of the business hurts them, that I'm willing to stick around for a 6 months to a year and a half or whatever until the economy gets better or whatever. That's fine. But I think the real thing is, to me, I want to find companies that are going to be able to grow, or maybe not grow as much when the market turns, and that's really key to me. And I think that for the most part, as I've been doing a better job at doing that over my career, saying no to companies that look very appealing, because I can get this great run out of it on the operating leverage. But when the market turns, or the economy turns, these guys are going to hit really bad, and it's going to hurt me on the downside too, right? So
yeah.
But if you find a company that's going to go from like a 1% market share to a 5% market share, a downturn in the economy might be good for them. They'll be able to steal some companies from market share from weaker companies and grow. Like I have a few of those right now during COVID that are making acquisitions right now at really cheap valuations of competitors that just can't compete anymore. So it's all in that. I haven't had a situation where where I've really been dinged by the operating leverage, the fixed cost thing, because most of my companies have been pretty stable in the revenue and be able to grow through good and bad times. It's the gross margin that's a little trickier for me, because you look at some of these companies, with inflation going on now and the supply chain, pressures. I got hurt on my companies in places I didn't see it happening, and their gross margins got dinged.
Okay. One direct question: net income or free cash flow?
Oh, I like to see. I don't like to see too much of a difference between cash flow and net income, right? You want to see? I want to see pretty. The closer they are, the more I like it. But I'm looking at both. I'm looking for companies that I have a decent free cash flow that can grow internally. That tells me they can grow without raising money, right? Look, I know psychologically, earnings per share are what drive companies in the short run. Investors they don't look at free cash; they look at earnings per share, right? Most retail investors are going to look at earnings. So I try and balance the two together. But most of my investing has been earnings per share. But I clean it up, adjust it. I clean the earnings per share up. I'm going to the cash flow statement, for example, to take out certain things or add things to adjust the earnings per share to maybe a non-GAAP or adjusted EPS. So I'm not looking just at GAAP earnings per share.
What's your approach to the risk? So in the course, I'm talking too much about to try to analyze Tenki, to try to understand the balance sheet, to try to investigate which cone is material. For example, a company that the goodwill was 80% of total assets, you should to investigate that number. You should to learn about what is buying. So what is your approach with the forensics and due diligence? How do you investigate your balance sheet?
Yeah, so look, I'm looking, obviously I'm looking for, the first thing I'm looking at when I look at the balance sheet, even before I look at the balance sheet, in the SEC documents, when you go to sec.gov and look at a 10K or 10Q, I'm skipping right to the liquidity and capital. The capital and liquidity was a capital resource and liquidity section. It's a section in the filing that talks about the ability for the company to basically operate without or with raising money, right? So they talk about the health. So I get to see right away, okay, if management's telling me in that section, usually there'll be a direct statement for most companies. We can grow for the next 12 months or foreseeable future without having to raise any money.
I think you can find this information in the control table note. I'm not sure in the OTC companies, but in the big companies, they have to report the contract table, and this is the outs of cash that the company has for different things, and you can view 3-5 years where the cash goes out, right? So,
right. Yeah. The smaller guys, for the smaller ones, I don't know if they got to do that though. The microcaps, but I have to look at that. Have you seen that in the nanocaps? Have you seen that with an ATGen or maybe a KRMD?
No, not for these companies.
Yeah. So now I'm looking for one to say, okay, well, we have to raise money to execute a business plan. Now I'm a little more skeptical about that one, right? Because I know dilution's coming potentially. So I'm looking at that first, right? And then I'm going to the balance sheet to see, okay, are there any kind of the more complex the balance sheet is, the more I don't like it. So I see if I start seeing convertible warrants, convertible preferred, stock, convertible debt, all these things can turn me off to the company really, because a lot of that means dilution coming down the pike. But so generally when I'm looking, so beyond that, so I'm looking for companies, for example, that have like a current ratio of at least 2 to 1, so that their current assets are greater than their current liabilities. Now again, remember, this is not all the time, but mostly. Now, if a company has less than the current, maybe maybe not a 2 to 1 ratio, but I go back to the last 10, 15 years and see that it's always operated that way. Maybe it has a high conversion of account receivables, whatever. Maybe that's just how it operates. Maybe a lot of credit. So again, it's all looking at that, right? But see, if I see a low current ratio and I see a very favorable liquidity statement, that might make me feel a little better, right? I'm looking at return to equity. Ideally, I like it to be in that 15 to 20% area or going there. To me, that's kind of where I want to be. I always calculate if I am going to look at book value. I'm not a huge book value fan. It depends what industry you're looking at, right? Some places you don't look at book value. Some places you do. But I'm taking out all the intangible just to see what the worst case scenario, what the tangible book value is, right? So taking out the goodwill and these kind of things to see what it might be worth, just based on that. And cash, I don't have, the cash per share thing is like, look, you haven't, there's again, I want to see, if a company has too much cash, that's not good too, right? But I want to go back and figure out over time what kind of cash that company is operated with as a percent of its assets, or maybe percent of, net income or something, to see how it's fared in the past in terms of being able to grow and raise and not having to raise money, for example. But of course, the free cash flow will probably be, in conjunction with that, right? Would be interesting, would to look at. And that's, I'm looking at for, a reasonable, account receivable kind of, days of account receivable kind of calculation there to make sure they get paid in time. And if that's changing, has that changing over time? I'm looking to see if I'm seeing a big increase in account receivables, but less of a growth in revenue. That's kind of if something's off there, if account receivables are growing faster than revenue, for example, that can be a sign of things to come. But looking at inventories, if I see a spike in inventory with a lot of positive things going on, that might tell me these guys are getting ready for some big quarters coming up, right?
So I think this is an important part in microcaps, right? Because the balance risk is so high, and could be the difference with losing all your money or not, right?
Right, for sure. I mean, I have one company where it's they sell used cell phones. They broker them, right? So they carry a lot of the stuff. So what they'll do is when there's an iPhone upgrade, for example, they go out and buy all these used iPhones the trade-ins and then resell them. So they need inventory to meet. So if they can't get that inventory to meet that demand during the upgrade cycle, they can't make it. They can't make their revenue. Sometimes you might have a situation in that company situation where they have all this revenue getting ready for a big thing, and then something goes on in the industry where let's say that a new iPhone is coming out, right? And they've purchased all these used phones in anticipation for the new iPhone coming out, and the iPhone the new iPhone isn't good, so nobody wants to turn their phone. Everyone just isn't going to buy the new iPhone. They're going to keep their phones, or whatever, and they're not going to trade them in. So these things can happen. So yeah, I mean that's but every company again is different, But in general, I'm looking for these cleaner balance sheets. I am looking for if I come across someone with a lot of debt, I am going to look at the last 3 years and see if they've been reducing that debt over time. But I generally don't like to see my debt to equity ratio. I mean, generally speaking, I like it to be under 20-25% is where I like it to be.
Okay. And later that doing all this analysis, do you like to try to contrast the information that you reach from the management? For example, if that company is a consumer company, do you go the same than Peter Lynch? Are you going to the supermarket to talk with the shoppers, or are you talking with your wife if you don't have about which products they use? I remember this from the Peter Lynch, and I think this is really good because especially in microcaps, that maybe you don't have information, but you can look where you can reach this information. No, if it's the services, it's a product company. So are you doing that kind of things? Are you talking other people, competitors, distributors, suppliers to try to check the information?
Yeah, well, yeah, sure. And I'm going to be. I used to go. I'll go to the. If I'm going to buy a retailer, I'll go to the mall, check out the retail. If I'm going to invest in a restaurant, I'll go eat the food. I'll like in the case of ATGN, we'll try and get information from the resellers that are reselling their have reselling their services. So we're doing that for sure. And I'm actually talking to competitors too. I'll call a company that's in the same industry and talk to them and ask them about what they feel about the company. For sure, it's a big part of it. It's a big part of it, but it's not like some things aren't going to be as easy to get intel on, right? As others are.
Okay. Before going with the answers, can you talk about your perfect stock today? Is it Ketel or do you have other name?
Yeah, I like KTEL a lot. KTEL for sure. That's what I've been talking about a lot lately. It's down today pretty bad with the market falling here. But KTEL is an interesting company, and this meets all those requirements we talked about. Or most of them. It has a great management. So KTEL basically is in the cloud communication arena. They have one division that does that. So helping companies take their communication systems off premise to the cloud. And they also have another division where they sell telecom services to low income households. And they get subsidized by the government in the U.S. to do that, so it's free money. And what's happening in that part of the business is that the subsidy rates that they're getting have gone up significantly because of a couple of new bills that passed recently. So it's basically going to be, and they're going to get this crazy amount of revenue and cash flow here. We predict in the next 18 months. So that division, so the company in 2019, I think finished the revenue about 9 or 10 million. I think this year, 20. I think this year will end about 13 million. That division was doing about $1.5 million, $2 million at the end of 2020. And I think they can get that, just that division alone to, 20, 30, 40 million in 18 months. Just on that. So the market hasn't figured that out yet because the company really hasn't done a great job communicating the opportunity. But if you read the SEC filings for the company, you can start seeing some of the stuff they talk about where you start putting it all together. You can start putting a real high probability case of that becoming true. And now that cash flow is going to be used to invest in the sexier tech side of the business to help those marketing efforts there. So
okay, I'm starting to show questions, right? But the first question is related that you have, I think, good news because you are in a process to set up a fund or something like that. So here you have the first question, right? So diversified portfolio or concentrated portfolio? And then you can add with this new fund if you want to share something.
Yeah, Rob, I really can't market that yet because it's still in process, so I get in trouble doing it. But yeah, I am working on doing that, so I'll keep you abreast of that. Yeah, look, I mean, let's just put it this way: I'm a little of both, but much more concentrated than I used to be.
How many stocks? 15, 20, 5?
About 25 right now, yeah. But I used to have in the hundreds, and over time, I brought it down to like. And I think I want to get smaller and smaller. I think to me, ideally, I want to have like maybe 10 to 15 stocks. And maybe most of it, maybe 80% of it in my top, maybe 90% in my top, like 5, maybe is how I kind of foresee myself going that direction.
Are you comfortable running a fund with only 10 stocks? But there are US investors that they have.
It was a fund I would do a little different. Yeah, I would get more. I would probably say that, maybe 2025 area for the fund. Yeah.
Okay. Here we have another question. They talk about attractive country, I suppose is the US, right? Here in Europe, the Nordics, like Sweden, Finland, is really amazing. Also the UK. But what do you think?
Yeah, I stay in the U.S. I mean, there's North America, a little bit of Canada. There's 20,000 stocks for me to choose from here. I understand the financials and how to invest in them and how to interview management teams here. But I'm not saying there isn't opportunities in other places I'd like to explore eventually, but I just see so much stuff over here right now that it's easier for me to get it, easier for me to do my research process here. But I'd be open to investing outside the U.S. for sure and outside Canada.
Okay. What do you think about business cycle or fluctuations? This is the reason because you are not investing in cycle stocks?
Right. I don't pay attention too much to it, really. I really pay attention. My philosophy really is 90% I'm looking at the company and just trying to invest in companies that can weather the storm, and look at and position myself where if I can't, if my companies are going to get affected by that, I'm just going to they're going to survive and hold on to it. So I don't do a lot of predictions in business cycles, economic cycles. They come and go, and I'm never going to get that right. I think the best thing to do really is along the way that you're always, saving money, investing wisely, and taking some profits off the table so you can invest through cycles. I like to say, you invest through crisis, not in a reaction to them. Just try and go through it. But now, I'm not saying that there's not a skill in doing it. I mean, some investors have a great skill and they're able to do that, and I have respect that a lot. It's not the way I've invested, though.
Okay. Here, Paco says, well, congrats. A pleasure to be here, right? Okay, gracias, Paco. Alvaro is talking about aggressive dilution is a red flag.
Yes, to me it is. Really, I mean, look, I understand that somebody's they want to come in and make some acquisitions. That's fine. If they're raising money sensibly to make good acquisitions that are accretive to earnings, and I'm okay with that. But dilution is like kryptonite. It's just not good for stocks. And I want a management team that understands that, believes that, and I want to go look in their past track record and seeing how they've approached that in the past.
What do you think at the today evaluations? So many people is comparing the today evaluations with the tech bubble. In my opinion, I think today could be worse because in 1999 the interest rates go the 10-year the T-bill was at 5, 6, 7%. Today it's at 0. Yeah. So valuations are much cheaper because interest rates are lower, negative. So now if you take the value of a stock with net income or free cash flow divided by the discount rate, this discount rate today is so low or negative. So the value of the stock could be infinite, right?
Right,
so
right.
How you compare the today environment with the tech bubble? Do you think it's similar? Is it different?
It's a little different, but and a little similar. I mean, it's pretty insane to me that the tech bubble was a situation where you had a lot of companies with no revenue, nothing going crazy, right? So yeah, that would just stocks are going to go to zero. Today you have like companies, blue chip companies, and high revenue. I mean, maybe low growth, but just these big cap companies just getting valuations that are crazy. But it's because rates are so low. And if we go into a cycle where rates are going up, I'm curious what's going to happen there, right? But you do also see this. The part that reminds me of the tech bubble is you have a lot of pump and dumps, the SPAC environment. You remember that the whole thing going on now. So you have a lot of irrational investing going on in these areas that don't deserve to go up, probably, and that's going to unwind. And maybe it's unwinding now. I don't know. I think it's hurting the nanocap space to a degree because there's a lot of undervaluation we see in the nanocap area for sure. That's just, these stocks are getting obliterated right now and getting cheaper because of what's going on lately. But I think it's a scary market because you've had this reckless abandon for a longer period of time. The tech bubble was quick, right? We've been going through this little bubble argument for years here. And it's, you know, it's bound to, you would think it's going to burst, but I mean, who knows? But I don't feel comfortable with it. And it's going to take down a lot. It's going to take out the good and the bad are going to go down together, right? So.
What do you think about the Russell? Russell is down 12% from the highs of the last 2 weeks. Do you think this is an opportunity, or do you think that wait and see?
Well, I think you can find, if you do your research, you'll be able to find, you know, some interesting stocks there. And I don't hunt in the Russell too much. I hunt, you know, in these really nano cap companies. But look, I think there was a lot of stocks in the Russell that shouldn't have been where they're at. You probably have a lot of companies that are being valued on sales, not earnings, and they're probably coming down. So you're seeing a lot of mean reversion. But I do believe that falling markets, if you do company analysis, you'll be able to probably find some great bargains in these downturns. Yeah.
Okay.
But I don't know if it's time to go in now. I mean, look, it's this whole COVID scare now is making it interesting, right? So.
Okay, great, Maj, that we spent here 2 hours. So thank you for your time. Really appreciate, and I expect that the audience and enjoy this conference. Okay.
Thank you, Quinn. Thank you, everybody, for being here. Really enjoyed it.
Okay, bye.
Bye.
Bueno, espero que os haya gustado. No es fácil traer gente de la talla de Maj. Trataré de traer más inversores, como sabéis, al canal. Por eso siempre os comento que es importante, pues, que este canal crezca, porque si crece, pues me será más fácil, pues, convencer tanto a inversores americanos como a CEOs de empresas americanas, porque yo creo que estoy convencido que somos el único canal que estamos trayendo pues CEOs, directores generales de empresas americanas, europeas, pero sobre todo americanas, e inversores de la talla de Maj y otros, pues, que también, pues, como podrían circular por el canal, como Jan Cassell o Conor Halley, todo este tipo de gente que yo trataría de traer al canal para vosotros, pues para que podáis hacer preguntas, para que los escuchéis. Y al final todo esto es para que, pues, el inversor retail, es decir, vosotros, pues tenga acceso tanto a un inversor profesional como a un CEO de una empresa. Entonces, os pediría que retuiteéis este contenido, lo compartáis en vuestras redes sociales, le hagáis like, porque esta es la manera que entre todos, pues, conseguiremos que el canal crezca y yo tendré más fuerza, repito, pues para convencer a estos CEOs, a estos inversores de que vengan a hablar en el canal. Sabéis que en el canal hacemos muchas cosas. Aquí tenemos mensajes. Luis Alejandro, gracias a ti por comentar y por escucharnos. Álvaro Puig, gracias a ti. Un placer también. ¿Vale? A mí me encanta hacer estas cosas. Las seguiré haciendo. Sabéis que en el canal, aparte de las entrevistas, pues hacemos cosas temáticas. Cada semana hacemos un vídeo en directo donde hablamos, pues, de una tesis de inversión, de algo temático. El próximo directo, ya lo he dicho al principio, pues hablaremos de cómo contrastar la información cuando se invierte en acciones. Y también sabéis que hemos finalizado el curso avanzado en valoración de acciones. Yo creo que es el curso más avanzado que existe en el momento. Un curso de 35 horas que se realiza en 1 mes y medio. El que quiera hacer un curso avanzado, este es el curso. Si vais a la página web que tenéis en pantalla del curso, tenéis un formulario de registro, os podéis registrar para la segunda edición, hay una prelista ya hay gente apuntada. Siempre lo digo, las plazas son limitadas, máximo 50 personas, ¿vale? Eso es para garantizar un buen aprendizaje, ¿vale? Los requisitos es unos conocimientos mínimos de contabilidad de finanzas, aunque el curso va desde 0 hasta nivel avanzado, ¿vale? En la página web ya podéis leer los testimonios, algunos de ellos, poco a poco los alumnos están subiendo los testimonios a la web. Si entráis en la página web, en la sección del curso, podréis leer lo que opinan los alumnos actuales. Yo creo que la opinión en general es buena, ¿vale? Por tanto, os emplazo, pues, al próximo directo, que será este jueves, será el próximo jueves a las 7:30. Hasta entonces, espero que hayáis disfrutado la entrevista y nos vemos en el próximo directo. Un saludo y buenas noches a todos.